Howdy, Jacob here. Today we're looking at next company in our generic stock screener, ticker symbol EPAC in the machinery industry, 2.4 billion market cap, essentially the same enterprise value, founded in 1910. They manufacture and sell a range of industrial products and solutions globally. Okay, revenue growth is heavily down from 10 years ago, but is fairly consistent over the last 7 or 8 years or so. There must have been a sell-off in 2016 to produce that revenue growth decline. Let's see. We actually don't see that. So there was just a huge, massive decline 2016 to 2017, which is very odd. And it doesn't look like it was a sell-off of assets. Wasn't any devastation. They obviously wrote off some goodwill going from 743 to 266. So there was about a $500 million of goodwill that was written off. So maybe their acquisition didn't really work out very well. But their gross margin is up quite a bit, operating margin up a bit, positive sign. Most recently, looks like a good return on invested capital, but historically, nothing too impressive. Paid a dividend of 4 cents. It's going to be 0.09% yield. I mean, that's jack nothing. Balance sheet, 167 million cash on hand, 5 million short-term debt, 190 million long-term debt. So we're looking at 30 million net debt. So we're definitely not concerned with that balance sheet. Use of capital, a little bit of debt reduction. Dividend pays out 2 million on averaging 60 to 80 million. So nothing really there. It's going to be heavy on share repurchases. So I'm ready to make some assumptions here for the revenue growth side. I mean, it was very interesting to see those heavy declines over here, but I think I'm going to rely more on the most recent 7 or 8 years history, saying that they'll probably grow along the lines of with inflation. I think that they deserve a premium, no premium, but just in line, maybe a little bit less with a terminal value due to growth being a little bit less. I think for margins, I'd feel fairly comfortable going 8 and 10%. With share change of 24 million being 1%, 48 million being 2%. I think that's a fair assumption for capital allocation, saying about 60 to 70% of allocations going to share reduction. Outside of that, leaving 30 to 40% for that tiny dividend, debt reduction, and then acquisitions that are hopefully advantageous, increasing the efficiency of the business. We're saying these fall very heavily before you get the return we're looking for here. So I do think it's a good company, but darn it, this price does not look attractive given the growth rate that I would be presuming based on what I'm seeing. Hope you enjoyed the video.